Yeah, I know. We didn't blast this out to the entire MIH chat. We only put it on a couple of internal chats, and I know everyone's got W-2 jobs or busy during the day, so they may not have made it. But the point of this was I was really going to do this call with one person. Originally, I started this with Timo Klotz, who's in the group. So I did two different underwriting calls with him, like a part one and a part two. And then I talked to Marco and I was like, yeah, let's do something with, a couple of the new groups. Let's go through it, slowly and methodically. Everybody has their different underwriting techniques. You're going to hear different ways that everyone underwrites. So I think it's good either way. I'm not the guy who writes code or who likes to, sit behind my desk all day and create formulas or anything like that. I've been in sales, marketing, investor relations my whole entire corporate career of 20 years plus, real estate side by side. So I don't like to sit at my desk and create spreadsheets and make unnecessary work for myself, right? But I do love reviewing numbers, and when I was in corporate America, I used to, review heavy spreadsheets and things that we had to report to the shareholders and CEOs and so on and so forth. So, but when it comes to underwriting, because I get so intimate with the markets, with the brokers, and with the assets themselves, especially during due diligence or whatnot, I do tend to get very heavily involved in the underwriting. And if I need someone with a more tech savvy mind to change the formula or add this or add that, so that I could properly underwrite the deals, then that's what I normally do. I put together a couple of different things here. I put together a Canva PowerPoint presentation that I've kind of had over the last couple of years, and then I just kind of elevated it a little bit this week just to kind of have a layout for everyone to review. And basically, as I've been saying for years, underwriting is essentially an art, a science, and then some speculation as well. Because there's a lot of information in front of us that we can extrapolate for the proper underwriting reports. And then there's some speculation. And the speculation could be mitigated and alleviated to low risk if you're really on top of your micro and macroeconomic fundamentals in the environment and the local market, and how good you know your comps and rentals and whatnot. So that's a huge part of it as well. But what I'll do is let me first see if Marco allowed me to share the screen.
Yeah, you could share. And while you're doing that, I just want to tell, we're recording this for MIH, Rob, and I just want to say thank you for the MIH members who are going to watch this recording. I saw the presentation. It's going to be a great presentation. I mean, free calls like this you're adding such value, man. And we're grateful for this one and future ones too, and the other one that you recorded. So I love listening to these because, you can always learn something, you know?
Yeah, absolutely. Um, so let me.
Just go to the bottom. It should say share.
All right, you made me a co-host, right?
Yeah.
So I should be able to share easily.
Yep. There you go, dude.
Okay. All right. Now I don't know. Let me see. How can I get this into a?
You have to hit either presenting. I normally don't do it.
See, this is what
You
I'm
can even
saying.
leave it. You can even. This is laid back for MIH. You can even
Yeah,
leave it like that and just go down if you want. Whatever's easiest.
yeah. This is the tech part that I'm sure it's a little simple click, but
Hit the
There
tab
is. It's.
slideshow. Up at the top, you've got slideshow.
slideshow. All right, let's see.
I can't see top right or left for him.
Slideshow. Got it. There we go.
Okay.
Thanks, Howard.
All right, Mr. Musso, take it away.
Yeah, so I'll go over this slide relatively quickly, and I do have a copy of the PowerPoint that I'll attach. Um, I'm utilizing this and I'm adding to it. I want to create kind of a master class for underwriting in the document so that everyone could go back and forth with it. Um, but I've been putting this together, and then this morning I put it all onto Canva and tried to just make it kind of simplified at this point. But yeah, I mean, the art of underwriting, like I said, it's an art, it's a science, it's speculation. Everyone does it slightly differently. Some people have skill sets that lend themselves to finances and accounting and numbers, and they love to crunch, create formulas, and sit behind a desk and underwrite all the time. Like I said, I'm out and about constantly, project management, property management, sales, marketing, investor relations, big picture thinking, but it all comes down to the fundamentals of underwriting, before I make very, very solid decisions. And even some of the most accurate underwriting and some of the best decision making possible isn't always enough, because there are just so many factors that are constantly hitting you left, right, north, and south on a daily, weekly, and annual basis. So to have the underwriting as tight as possible is only going to help you and only going to alleviate issues that may occur short term or down the line. So so basically, I basically started off by saying, why underwriting is an art, science, and speculation, because it's not just about putting numbers into a spreadsheet, right? There's the art, there's a science, there's a speculation. And I really just want to focus on speculation. No matter how good your data is, you're still forecasting an unknown future. And that's extremely, extremely important. And why I say this is because there are some investors that look at your underwriting and they think it's a guaranteed mold, and it's scientific and accurate. And if 6 months down the line construction's delayed, or 6 months down the line we have COVID number two, or 6 months down the line, or 16 months down the line, something happens in the economy, there's a war, there's an economic, there's inflation, whatever it is, things could change. So we all need to be aware of that, nothing's guaranteed. It's all projections at the end of the day, but you're making the best decisions you can for the deals today based on the data you have and some speculation. So this is something I focus on all the time. I really honestly do. I honestly, like, my business partners like Marco and Jennifer and some others. I really would like to know the market better than the broker and seller. And they're not, most brokers and sellers are probably not going to like to hear this, but that's not as hard as you think, because it's just unbelievable how many uneducated, transaction oriented brokers and sellers are out there who just, it's just mind blowing to me that they are in, a position to sell a valuable asset, and have a fiduciary responsibility to the seller, yet the amount of information that you do not get, or the lack of knowledge that they have on the asset and the market itself, is mind blowing when you get out there. So over the years, I've built relationships with a lot of brokers and a lot of investors who know the market well, who are more savvy. But don't be surprised if you're doing your DTS, campaigns, or if you're going into new markets and dealing with brokers that you have never dealt with before, that you're going to have a lot of brokers who just don't know the market. So do not take it with a grain of salt for anything that they give you, and make sure that you know the market better than the brokers and the sellers, so that you make accurate decisions. And it's all things like cap rate trends, interest rates, supply and demand, net absorption rates, sales comps and rentals comps. I use MLS and CoStar to pull clean data, um, constantly. I have national CoStar access. And if any of you guys want to be a part of my co-star team, I have a group of seven of us who have very, very low costs to utilize, co-star right now, and I can add you to that. And it's minimal cost to be a part of the co-star team that we have, and you could review national reports, nationwide, and so much more. And that's a whole nother class I would do because I spend so much time in CoStar Weekly. I love it. I dig into articles, I dig into market reports, capital reports, sub-market reports. I analyze data, I create lists. Like this morning, I created a list of 617 multifamily assets in the Lehigh Valley and gave it to Dana and Peter in the MIH group to do a direct to seller campaign for me. I'm doing the same thing for industrial asset class right now. If I have 123 Main Street and I need to know everything about that asset that's 26 units, I can find anything and everything on that asset, on the market, on the sub-market, comps, sales, anything. So, and that's for multifamily, flex space, sales, rentals, comps, off market, and then there's tons of articles, and it's a really really good tool. So if you guys want any assistance with that, let me know. Um, Lending environment. This is a good one too, because everyone's like, why are you always meeting with so many damn banks? And I'm like, because they're like extended parts of my sales team. I have a couple of brokers in Manhattan and a couple of local uh, brokers in Pennsylvania and New Jersey who have connections to all different banks, private equity firms, hedge funds, whatever the case may be. And I use them as my secret weapon all the time. Um, if I'm, as much as I know about the lending environment, as much as I follow treasury rates, cap rates, interest rates, and whatnot, and as much as I know my local market, um, I like to use my extended sales team, I call them, which is the lenders. And sometimes I'll run underwriting in a deal buy, and I'm like, what do you think, Matt? Um, how does my lending look on this one? And I'll get really good information and feedback and say, you know what, Robert, you're being a little too conservative. I think you could be a little bit more aggressive. I just closed 5 deals in that market, XYZ factors, and I probably could get you 12 months interest only, you know, um, this community bank has an advisory board. They've been a little bit more flexible on interest rates, wipe out prepayment penalties, and we'll have these back and forth conversations that really go well. So build long-term relationships with your brokers and banks and look at them as extensions of your sales team because I treat them like CFOs. I really do. Site inspection and pre-LOI review. This is also very, very important. I remember years ago, a lot of people used to just throw numbers at everything and say $5,000 to renovate each apartment, $10,000 for a roof. And there was so many averages, and everyone would just focus on 45% expense ratio, $5,000 to renovate an apartment. And it was so loosey goosey, and it really wasn't, it works perhaps almost by accident in hot markets, but I get very, very bird's eye view approach on this. So, and it starts with that first tour. I try not to put an LOI out on anything unless I feel it's a complete gut job or so much add value that because I've done so many transactions over the years that I just know that I don't even need to see it. I know what I'm getting into. But let's wipe that out and pretend that, you don't have a lot of deals under your belt. You want to, you're doing your first syndication, you're doing your 20th syndication, whatever. The site inspection and pre-LOI review is very, very important. So, I look at things like, is it new construction? Is it vintage? Um, what type of capital expenditures and ongoing maintenance issues am I going to have? A building that's built in 1932 in Pennsylvania is going to be different than a 50-unit building built in 2019 in North Carolina. Big, big difference. Are the utilities separate? Are the utilities included? Um, and when you get on site, and when I'm with like my other business partner, Chad Gorman, who has a really good eye for this, or I'm with Jennifer, who, has property management and construction and maintenance all in one, and they usually come, tag team these reviews with me. We are looking at everything: roof, gutters, downspouts, windows, structure, landscaping, foundation, um, you know, uh, interior, every single unit, including corridors and staircases and basements and mechanics and MEPs, everything. And so I make my decisions on LOIs with all of that as well through that first site inspection. And I have to stress this as well. Those, even if you're really good at pointing out what may or may not be done, if you don't know average costs and you think it still costs $7,500 to renovate an apartment versus 20, or if you don't know that windows cost more today than they did 10 years ago, and if you don't know the proper pricing on roofs, you're going to get yourself into trouble too because you might not allocate.
Rob, let me say one thing to that. We used to turn a unit, say my 44 unit in Lawrence, 2 years ago. Maybe we turn it for like 8 grand. I think that now, 2025, 3 years now, it's 12 to 15 grand. You know, so depending on like you said, like if it's a light turn, medium turn, heavy turn, some of the turns are 20,000 right now. Some of the turns are 15. Some of the turns are 12. But you're not seeing your $6,000 and $8,000 full premium turns like you used to. So they could even pull back again. You know what I'm saying? Like insurance, by the way, in a recession, the multifamily insurance went from, say, my 44 unit went from 12 to 30,000 or 28,000 in like 2022, 23, 24, whatever. People don't realize, they think insurance is going to keep going up, and keep going up. Not really. They don't realize it. Sometimes when the economy turns down, it gets good. We'll get insurance. It'll come down. It'll trickle down to from like 28 to 22. Dead serious. That's what happens in a good economy. Things level off, and even insurance is never going to go back to the 13. But in a recession, the insurance gets spiked, even like 2008, bad. But then it levels off and even comes back down a little bit. Like, or you'll get a company that's like, we can compete. So even on the turns, Rob, when they go up, I don't think they're ever going to come down, but sometimes they do level off because building costs come down, materials come down. It's that recession that really ruins everything. Sorry, go ahead.
Yep, absolutely. Um, and then when it comes to your rent and expense projections as well, um, you know, we're, we're constantly looking at, avoiding making mistakes and trying not to be too aggressive. So it's a common mistake that a lot of investors make. And when a lot of people ask me to review their underwriting reports, and I do see a lot of overcompensation for rent growth. And today is a perfect example of why you should be very careful depending on the market, depending on the asset class, et cetera, et cetera, with supply, with net absorption rates. Be very, very careful on overcompensating rent growth, because if you overcompensate rent growth, then what's going to happen is that um, your refinance might be off, and then your sales returns might be off as well. So I underestimate, I underestimate rent growth, and I underestimate, and I overestimate expense growth. And sometimes people do the opposite. So inflation is affecting everything right now. It's affecting property taxes, insurance, repairs, utilities. It cost $800 to do a hot water heater 5 years ago, 7 years ago. Now it's costing 1,600. Insurance is through the roof. The fires in California and the floods and the hurricanes in Florida and South Carolina are affecting insurance nationwide. So this is another big area where people make mistakes, where they review an insurance policy from the current owner or seller, or they look at an OM and they think it's going to be the same for the next year, and then they'll say 3% expense growth for the next five, when they're not compensating the fact that most insurance policies right now are going up 40 to 80% plus plus plus. So be very, very careful. It'll crush your underwriting. So try to build a realistic, year after year escalation into your pro forma. Otherwise, you're going to get yourself into a lot of trouble as well. Um, let's see. Another huge, huge highlight: property management, internal versus third party. When I left corporate America, the first thing I did was manage all of my own properties myself. I started my own property management company. I self-manage a small portfolio. I took on a few customers who I met through networking, but I did everything from A to Z. I implemented the first software that I ever used, Appfolio. I walked every single unit with every single tenant who is a potentially going to be a new tenant, and I use that sales and hospitality and property management approach. I met with all the vendors. I met with all the contractors. Whether it was a small renovation or a large renovation, I was there every single day, sheetrock falling on my head, dealing with the orders at Home Depot or local suppliers, negotiating prices, creating my own RFPs and contracts, dealing with attorneys, dealing with all the accounting, dealing with anything and everything under the sun that comes up with a good, bad tenant or indifferent, from local magistrate to evictions to rent renewals, up to lease renewals, whatever. As a result of that, I had, I felt very, very comfortable eventually moving away from all of that and going to a third party. I wanted to be more in the sales, marketing, investor relations mode and not manage my own properties. You'll hear a lot of people who will think exactly the opposite. They want to manage all their own properties. They want to self-manage and create a company. That's great. Maybe one day I'll revisit that, but I'm using a lot of third-party management right now. But if you don't have that experience, you cannot just think I'm handing the keys over to the property management company and things are going to be good. It is a myth that that will happen. So make sure that you understand how property management works, that you do not get yourself into a position where you are going to have the wool pulled over your eyes in any way, shape, or form, or bring members on your team who know operations, sales, marketing, property management, project management, so that you're always protected and you are proactive versus reactive. Because there's a lot of property managers out there right now who are reactive and not proactive. They're not thinking like an investor, they're thinking like a transactional property manager. They react to calls coming in. They do very little to help you grow your rents. They do very little to retain tenants, which then cost you money in turnovers, which then cost you money in commission, which then could lead to possible vacancy issues. If you don't have a good property manager, you might have guest tenant dissatisfaction versus satisfaction. That could lead to bad word of mouth marketing. That could lead to less referrals. That could lead to overall negative growth for your asset overall. I have been in situations where I've taken over assets with horrific property management, third party. I've changed it, and dramatic results occurred. So, and no matter how much you think you vet a property manager, never let them take over the steering wheel completely. um, you have to be on top of them. So, and you can be on top of them by asking for proper reports on a weekly basis, having bi-weekly or monthly calls, visiting your property quarterly with them, making sure the property manager visits your property every quarter for thorough inspections, making sure that they have good software where you can control these reports, review these reports, and manage things correctly. So very, very important. What did I do here? Oh, yeah. Okay. So this is another area that my team members usually say I'm very, very conservative, and I think they're saying it as a term of endearment, but they know I like to protect the investment in the capex and reserves. So I think that smart investors protect against the unexpected by looking very carefully at your working capital, your deferred maintenance, your emergency funds, your vacancy reserves, and your catastrophic reserves. I also look at this, I take my real estate and hotel approach together. So when I was in the hotel industry, I basically represented five-star luxury hotels with beautiful restaurants, gorgeous golf courses, tons of high-end rooms, beaches, city locations all over the world. If a hotel was renovated, if we spend 500 million or 750 million on a renovation, within 3 to 5 years, those rooms already look like they have so much wear and tear that we needed to put more money right back into it, which is crazy, right? When you think 3 to 5 years, I just did these renovations. It's the same thing with real estate. So you're putting all of your money up front into the real estate deal. So let's say, for example, Howard and I buy a 10-unit property and we're allocating $10,000 per unit year one to slightly upgrade. It's not doesn't need a full gut job, but we're going to change a couple of floors. We're going to change a couple of cabinets, maybe a couple of appliances, nothing crazy, 10,000 a unit. What's going to happen in 3 to 5 years from now if this is a 7 or 10 year hold? We might need to spend that money again. So I normally put, and you'll see it in all my underwriting, I normally put another reserve fund in the deal so that I never have to have a capital call with investors or the JV team to put money into the project 5 years from now. Because think about it. If rents are growing 3 to 5% a year for the first 5 years, but the wear and tear on your property is going down, how are you going to keep up that level of rent if there's a wear and tear and new supply on the market that's making your product look tired and old, just like a hotel? So, um, very, very important to think like an expert, to think very proactively about all of that. I tend to see that too many investors get very, very aggressive on their reserves and capex, and it hurts them in year two, three, or four, especially. So be very careful about that. Take a screenshot of this because this is very, very important when you're underwriting deals in that section. Um, Analyzing financials like a pro. Talked about a lot of this already, but one of my business partners also says, "Wow, you're really getting granular on the P&L every time you underwrite a deal." And commonly, you'll get an OM from let's say you do work with a decent broker, you'll get a pretty decent OM from some of the bigger brands out there, from some of the more proper firms. But remember, their fiduciary responsibility is to make the seller money and make themselves money. They are working for the seller. So when you're analyzing an OM, do not look at it as gold. Don't forget to don't just skim the P&L and throw it into your underwriting model and think this is it. There's probably no other hidden costs if this is what they're giving me. Yeah, you can only take the information you're given at that time. And when you get into a due diligence period, you'll start finding out what's true, what's not when you audit everything. However, don't just skim the P&L, dissect it. And that's how I kind of wrote this from my own words. Dissect it. Look for hidden and excluded costs. What do I normally see that's missing? And what do I normally see that I include? Leasing commissions. Do you ever see people say, you're projecting a 5 to 10% vacancy every year, but are you projecting that you're going to have to pay someone for leasing commissions if you're doing third party management? You rarely see it. Turnover costs. Yeah, you have repairs and maintenance, and you have pet control, and you have snow removal and landscaping and whatnot. But what about the turnover costs? Sometimes brand new apartments cost 800 to 1800 just to turn over. So I like to look at my vacancy and let's say I have 10 units and 10% vacancy a year, and I'm always expecting 1 to 2 units to turn every year. I add leasing commissions, I add turnover costs. Another huge one in most municipalities that I've worked in with, codes, fire and safety compliance is part of every deal, and that normally costs you quarterly costs for fire and safety and fire extinguisher inspections. All stuff that you rarely see in OMs, but it's gonna hit your books. So make sure you do that. What about cost segregation and accounting? Make sure you have cost segregation for year one in there. Even put it into the reserve fund if you want for your investors and let them know, you know what, we're going to raise for the cost segregation. We'll put it in there so it doesn't affect year one cash flow. But for accounting every year, I got to produce 5 or 6 K1s. I got to produce 20 K1s, or if it's a JV, whatever it is, there's accounting costs and cost segregations that are commonly forgotten in some underwriting models as well. So always request as much as you can from the brokers and sellers. And that's obviously a T12, financial reports, OM, current rent roll. But look for those hidden or excluding costs because they will creep up on you and hurt you if you miss them. And then you'll be surprised when you see them while you're actually operating the building. Another very, very important aspect here is I think this is kind of common knowledge and standard, but make sure that you understand comps beyond price, right? So that's why, if you're getting information from your broker, if you're like myself who looks at CoStar, if you have other areas like Zillow or Trulia where you're extrapolating information yourself, everyone's using Chat GPT to extrapolate information right now as well. Or if you're using CoStar, just make sure you know as much as you can for that location and those price points to help yourself out. So aggressive versus conservative models, obviously, I told you I'm a little bit more conservative, but I do also write aggressive models just to see, all right, like a worst case scenario and a best case scenario. A lot of times I'll make decisions on my worst case scenario. I'll say, well, if the worst case scenario still looks good, then let's get an LOI out and move forward. Um, and this one here is, I get this question a lot from investors. Are you holding this long term? Are you holding it short term? And this is another thing. When you're underwriting a deal, you have you have you can't guess, but you have to, properly guesstimate what the strategy is for this building, right? Are you going to hold it long term with no refinance? Are you going to hold it long term and refinance at one point in year 3 or 4? Are you planning on renovating it, adding value, and flipping it? All these things are critical that will spit out the returns that you need to make proper decisions on how you're holding it. So don't just assume everything's going to be a 5-year refinance and a 10-year hold, or a 3-year refinance and a 7-year hold. Think about it very, very specifically and strategically as you're making these decisions, you know, and they'll those differences between 3 years and 5 years and 7 years and 10 years, they'll affect your IRR, they'll affect your equity multiples, they'll affect your average rate of return. So it's very important to make sure that you're on board with the strategy. And if you are holding deals 10 years, you're going to have some ebbs and flows with cap rates and interest rates. You're going to also have that issue that I mentioned a few slides ago, which is you might need to renovate some of your units again, and you might have to hold that extra reserve fund as well. So, all right. So, okay. So you have a lot of information right now, right? But how are you underwriting this deal? Are you doing it on the back of a napkin, which is how we did it years ago? I remember my grandfather and dad, they used to do things, 10 times rent roll before we had computers. Um, you know, but today we have so much technology, you have AI, you have so many software models out there. So you need to find the software model that works really well. Fortunately for us, we're in a great mastermind, and my very close friend, the business partner, Chris Jackson, has the synthesis model. I've been using that for over 5 years now. And I really do think it's one of the best. And if it wasn't, I would not be using it. Um, but I love his model for many different reasons. It's speedy, it's accurate. I can look at different scenarios. I like the way I can toggle through the whole document and look at several different scenarios very, very quickly. When I send this to investors, when I send it to banks, when I send it to business partners, there's aspects that are really important for the bank. There's aspects that are really important for the investor, especially investors want to get granular. Well, I'm giving you $200,000. I want to see what my $100,000 might project, and you have actual investor samples and slides that you can give to them, from the P&L to the summary page to the mortgage to the investor data. It's a great, great, great tool. So, his website is at the multifamilyanalyzer.com, and it's definitely a great tool for everyone to use. Um, I get these questions weekly. I honestly do. You're underwriting deals for 2 years, but you still don't really understand what. I'm not even really sure what the cash on cash return is. Is that the same thing as the cap rate? Is that my preferred return? This, that, and the other. It's amazing. I'll speak to people who have been in real estate for, I think, a decent amount of time, and I feel that they have good knowledge, but some of these formulas are completely off on what they think they actually mean. So I put together some formulas here, for everyone to review and keep at their side. If you want to go back and look at it, I'm not memorizing formulas like I'm back in college, taking algebra or statistics. But yeah, there's some good examples here, from your cash on cash return to your average rate of return to your IRR to your equity multiple, and how they all work together. So these are all guides. Okay, you look at all these returns, you look at how aggressive or conservative you underwrote the deal, and then you could obviously make some decisions based on that. So a well underwritten deal should pass a few tests as well, and these formulas are going to help you make those accurate decisions. And then you have deal structure, right? What is really the difference between a joint venture and syndication? And, I think there's a lot of deals out there that have a hybrid approach. I've seen these hybrid approaches for years. Um, I've been in over 118 transactions. Most of them have been joint ventures. I do not consider myself a syndicator. I own a lot of deals by myself, 100%. I own some deals with one partner, 50-50. I own other deals, 75-25. I have some deals that have a joint venture structure with a slight hybrid syndication approach. If someone's guaranteeing the loan by themselves or if someone's playing more of a lead role. And then there's syndications. Um, and syndications are completely different, and they do have preferred returns, and they do have general partner and limited partner splits. And you do have to adhere to SEC rules and regulations, and they do have to be 506B or 506C. So all of those definitions, formulas, structures, and guides are in here to make sure that everyone really knows what they're getting into on the buy or sell side, or when you're putting together a deal on paper, because the overall returns might look good, but when you break it down to a GP LP split, it might not look so good for the limited partners unless you properly allocate the right returns and preferred returns and whatnot. So, very important to understand all of those structures while you're underwriting deals as well. And here are just some definitions of what these deals mean for the sponsor and for your investors. There's rules, like I said, 506C, 506B, passive, limited partners, active investors on the GP side, things of that nature. So they're all here as well. And then you have common terms like promote and waterfall structures as well. The promote is the GP's profits above and beyond their proportional ownership. So, um, you know, it's very, very important as a sponsor on any deal that you take care of your investors first. I'll see a lot of sponsors take asset management fees before they take care of their preferred returns for their investors. And I would never do that. What I do is all profits have to go to or all cash flow and profits have to go to the investor first. Once the investor's preferred return is met, then the promote, then the asset management fees, then any additional splits should be done accordingly. I think, and I truly believe that that is the proper ethical and moral responsibility that we have when we take anyone's money and capital with these projections. Okay. A waterfall is a tiered distribution methods where returns are paid in a certain order.
Hey, so Shiva never sent Tamik or I Carmen's application. Sorry.
Oh, it's okay. I thought you were asking a question. Um, okay. So yeah, these are kind of Q and A's I was going to talk about, but I also wrote it down on paper. I think a lot of, I've been thinking about a lot of these investor calls I've had lately, a lot of these coaching calls Marco and I have had. Um, and when I review underwriting, I reviewed like 3 underwriting models for someone last week, and everybody was talking about the same thing. What do you think about interest rates going down? What do you think? When do you think it's going to be a good
Rob,
time?
you know what video I'm doing today? You're talking about JVs. I'm doing 3 things: straight partner deal, like me, my brother Jake, and Mike Alchi. Number 2 is a JV deal. Number 3 is syndication. I'm going to explain all 3 in the video for MIH members, because like a lot of new members or even some older members, they're not understanding JVs right. They're like worrying about like a 70-30 split, 60-40, 50-50. I'm going to explain to them the deal that has a 50-50 split on a JV might be better than your 80-20 split on that other deal, because the 50-50 one is a bigger split, but the deal is 10 times better. So, and I'm going to explain a regular deal with no splits and syndication. So it'll help them with this, like even with the underwriting you're going over today. I'm really going to clarify it in a video I'm going to do today for them while I'm walking.
Yeah, I
Okay.
talk about, yeah, as you know, great point. As you know, I talk to you about that all the time
Yeah.
because, what's the difference if Junko is looking at 180 units in Florida for brand new development community, and her return and it's a 90-10 split favorable for her, but if her returns are lower than what I'm offering you on a 10 unit JV in Pennsylvania, what's the difference?
Yeah.
Um,
For
you
example, here's the other thing. Like you just said, say on that deal, say the finder fee, it's a JV, it's a 1%. Okay, so it's only 1%. Maybe it's like 20,000 a finder fee. But then on the other deal, there's a 3.5% finder fee, and it's like say 80,000 for the sponsors. But that one with the 3% has a 22% IRR, a 2.8 multiple, and the one with the 1% finder fee has like a 1.8 multiple and like a 15% IRR. So it's like I'm gonna explain to people, look at the fees, but also look at the returns after the fees. Because, people working the deals, if it's a super heavy lift, it's going to be a 50-50, 60-40. I will not do a super heavy lift for anything like, like we're going to educate people that even as JD, super heavy lifts, you have to do 60-40, 50-50, and there's got to be a 3.5% finder fee, or else it's not worth the work. Like Hadar's 80-unit deal, if he JV'd that deal, that has to be a 4% finder fee and it has to be a 50-50. That deal is like sucking the life out of him, and he's gonna not 100% refi, he's gonna like 200-300% refi. You know what I'm saying? So it depends on the juice of the deal too that we talk about, Rob. But I'm gonna do a video. I'll let you keep going because you're doing great.
Yeah, everybody has a difference of opinion and all that too, but I tend to believe that just be very careful as a limited partner because I am a limited partner. I'm a key principal, I'm a general partner, I'm a limited partner, and I'm a hybrid of all three. So I've been on every side of the fence, and I've gotten very granular in every deal. So as a limited partner, I'm looking at my returns. I'm looking at the sponsorship team. I'm looking at the reachability of the asset for me. I'm looking at my knowledge of the market. Just because a project in Florida or in Arizona looks glorious and magnificent and it's a big development project, there's a lot of risk associated with that. And these big projects usually reap huge rewards for the developers, and the limited partners are at risk. And you have to be very careful making those decisions. Your better decision could be dealing with a very, you know, organized and well experienced team on a smaller asset where you're a JV. Just because you're investing in a 200 unit big project doesn't necessarily mean that you're going to have a better return or a better result. Just be very, very careful. And I think that's common knowledge. Everybody knows that. But yeah, these splits, the 50-50, 70-30, 90-10, 80-20, whatever they are, look at your returns. Because as Marco said, I can have a 50-50 split with better returns than someone who's giving you a 90-10 split with less favorable returns. And then there's all these other factors on how you want to make your decision. And again, I've been on the larger syndications, the smaller JVs, and everything in between. So I really do get how it all works on all sides of the fence. But everyone should be aware because it's not as black and white as you think sometimes. And with that being said, we talk about the velocity of capital, we talk about the infinite return model. Going back to old school real estate 101 from 100 years ago to 50 years ago to today, the velocity of capital coming back, right? So you want to get into add value assets in a lot of cases, or assets that are in an emerging market where cap rates are compressing and you're able to create equity with organic or forced appreciation, add value, cap rates, the emergence of the market. And you want to refinance and get your money out of the project as quickly as you can so that you could reinvest that money elsewhere and still stay in the deal with limited to no capital in the deal so that your returns become infinite. So I look at this a lot and I try to follow this model, which is why I have dozens and dozens of assets because I'm always reinvesting my money and keeping my soldiers at work in new deals, so to speak. So every time I look at a deal, unless it's a legacy deal, Class A, something I want to maybe pass to my kids and not worry about as much and hold for the next 20 years for them, I'm always looking at the velocity of capital and the infinite return model. So, yeah, and make sure you're aware of how you align that with market cycles. Like right now, it looks like economic data, micro and macro, based on historical performance over the last 3, 4, 5, 6 years. And what we're all projecting, even though economists and some of the top economists in the world seem to be changing their mind every week, literally, um, it looks as if we're speculating that we may see a couple of interest rate cuts for various reasons, from tariffs to job growth, to GDP, et cetera, et cetera. So when you're modeling your, your project, when you're underwriting your projects and modeling your assumptions today, we're anticipating some of those aspects to happen. But what about 5, 6, 7, 8, 9 years again? If we're going on a different cycle, you got history does repeat itself. You have to look at historical performance. You have to look at today. You have to look at short term, and then you have to speculate on the long term. So that's always going to be a part of your underwriting, and it's never going to be easy to become as accurate as you like, because I just mentioned even the top economists in the world right now can't get things right and change their mind every other week. So the average investor is going to always have those tailwinds constantly. And if you don't want that, I don't suggest real estate. And if real estate's not for the faint of heart, and if you want guaranteed returns, then put your money into a mutual fund or a treasury bond, or maybe invest in, S&P 500, QQQ, SPY, um, which still is some risk, but a lot more mitigated and your money's liquid. However, just keep it in mind for real estate. It's not for the faint of heart. There's ebbs and flows. You're going to make mistakes. You're going to see the challenges that are out there, micro and macro, and with tangible and intangible things that are always going to happen. So that's kind of a recap on the art of underwriting to a degree. I think it's equal parts, like I said in the beginning, art, creativity, discipline, speculation, risk control, and the more detailed your process, the fewer surprises you'll encounter, the better team you have of all stars, the less mistakes you'll make, and the stronger you will be. And so, the deal of a lifetime comes around once every couple of months for some people. Sometimes you need to walk away and watch it come back. Sometimes it comes right to you from day one. And when you're ready, get those LOIs out and see where it goes. And that's about it for the slideshow. Um, and I wanted to open it up for any questions. And Eddie, it looks like you have a question and you are on mute.
Yeah,
Oh, I'm sorry. That's not Eddie. That's Howard. Sorry.
that's
What's
wrong
up?
button.
Yeah.
Rob, how many deals are you underwriting right now? How many deals are you looking at? Like, what is a week? What is it? What does a week in the life of Rob look like? I know that you're walking a lot of deals
Yeah.
and you're looking at a lot of markets. How many? But yeah, how many deals are you underwriting right now?
It varies, but I'm of the frame of thought if someone's telling you they're underwriting 50 deals a week, I think they're lying and they're crazy. So I look at a lot of deals weekly and monthly, but I cannot tell you how many deals we just from right off the bat I throw aside. And I think that's another dangerous thing to be in. Just because you have a deal in front of you doesn't mean you have to spend money, spend time, energy, and efforts on every single deal that hits your desk. There's some there are some deals that you should just know, this is way overpriced. Goodbye. Um, Not a big fan of this. Like there are brokers who are constantly throwing out deals that are way overpriced. There's a lot of competition right now on publicly listed deals. So I know that there's it's probably going to be oversaturated with offers, and they're going to get very aggressive on prices. So I would say on average, I'm underwriting 3 to 5 deals a week, because we scrap a lot. But at the same time, I'm at this 7 days a week. I'm hitting the markets every single week. I have some bird dogs sending deals my way. I have some extended partners who are doing direct to seller campaigns. So a lot of stuff will come to me and I'll underwrite real quick. And then some things I'll underwrite a little bit more specific if my gut's telling me, oh, this looks like it could be a good deal. So yeah, so I would say maybe 3 to 5 deals a week max.
And so
But
some of those deals, are you just doing back of the napkin and kind of seeing if they make sense, or are you at the point where you could just look at the numbers and not even need to back of the napkin it?
yeah, combination of both. It's a great question. Like some deals, some of the smaller deals, I'll know price per square foot, immediate location, vintage, and I'll look at like an overhead picture or I'll look at a Google map and or I'll speak to the investor, or I'll even just drive by the asset. I'm like, this is a 1935, uh, bad, distressed asset, and it's going to cost X amount, and let's pass on it right now. It's way overpriced. But then some of the larger assets, 15 to 30 to 50 to 75 units or above, usually you have a better broker with an OM and proper information. Then I'll dig into them and do a back of the napkin quick underwrite model, especially if I know my lending is in place and it's in good condition and I know the market well. So yeah, but I like to I like to actively, have a few things in the pipeline. So I'll give you an example of the last 90 days. We only underwrote, I think, 30 deals, and but we may have seen more deals than we underwrote weekly for the last 6 months. We underwrote 30 deals. We put out about 10 offers, and we have three in contract right now. We just closed on a 17 unit yesterday. We we're closing on a 20 unit that's in contract now. We have a 6 unit, 17-bedroom student housing in contract right now, and we got three more in the pipeline that are going to contract. And that's a result of 6 to 9 months of heavy, heavy hitting the streets, meeting with brokers, and doing a lot of the things that I kind of practice and preach in our local target markets. They're all in our local target markets. So, but great question, and it
Got it.
varies.
Thank you, Rob. Yeah.
But yeah. Um, Anyone else have any questions or thoughts or insights or anything you want to add?
I think this was like really great, a lot of information. And for me, like, as a beginner, like I feel like I have so much to learn. But I have one question. So when you look at the property and like, when you decide, okay, I want to do this like long-term hold or like short-term, like what are you really looking at? Like what aspect are you looking at and decide this is a long-term and this is, I want to make it like short-term?
Yeah, it's a great question. And again, it depends if it's smaller or larger, if it's distress and add value, if it's a legacy property, what market it's in. My investor profile usually comes into question a lot. I have a lot of investors who come to me, like family offices and funds and high net worth individuals who really don't care about cash flow, and just want cost segregation and tax depreciation. And they say, they look at it like an annuity, a mutual fund, a bond, and they'll just say, "Yep, as long the longer term hold, the better tax advantages for me. And if the market's emerging and appreciating in value, then in 10 years from now, when I'm going to retire, I'd love to have that little nugget in my portfolio." And then there's, the GP teams, positions, property management. There's a lot of what area in the market cycle you're in right now. Is the market in a distressed condition emerging? Is the market already kind of established? So a lot of different factors, Junko. It's a great question, but it does vary, asset to asset, deal to deal, and investor to investor. Sometimes we'll specifically have a group of investors that are requesting something, and then we'll go out and find the asset that meets their criteria, which we just did, for a deal, for example. So I'll do that a lot too. But it's a combination of everything. We're pretty much diversified across the board. Now, there's other investors and sponsors and teams that do the exact opposite. They only want, quick flips. They only want 3 to 5 year holds. They're only looking for red value. They will not touch new construction. So everyone differs. But
So,
it's
Junko, I have 410 active investors on a Google sheet. I don't use a CRM. I use like a Google sheet, name, cell phone, email, notes, like, hey, I put what deals are with me. I put if they're liquid. I also have columns. Dr. Kushner, I'll write, doesn't care about cash flow. He wants tax benefits and he's happy with appreciation. He wants deals, no cash flow for 2 years or 4 years. He's okay with that. Then I'll put like Mike Smith. He wants deals that are cash flow day one with a refi in like year 2 or 3. Like I make notes like that. So I have two columns. I have columns of like investors that kind of want cash flow by mid year one or end of year one, and then I have a column that says these are my high end doctors and lawyers and accountants that don't care. They just want to be in a good deal. Like we have a deal that's got no cash flow for 3 years, but it's going to be like a 2.8, and then in year 3 it's going to refi and cash flow. I'll look at the column. I'll reach out to my 30 doctor lawyers and accountants that are high end that like don't care about cash flow. So you know what I'm saying? So I
Yeah.
make categories because in sales, Rob will tell you this. If you're pitching a deal to one of your network guys, and he's like, you're like, oh, this deal's great. There's no draws for 2 years. Da, 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 and then at the end, he's like, yeah, but I want cash flow, and you still keep going. It's like you're pushing the wrong person and button. Like you're selling him the wrong thing. You have to learn your investors. And what I say to my investors once I send them like the Zoom link, I'm like, at the end, I'm like, come to the Zoom. Even if like the doctor, even if this guy wants cash flow and it doesn't have cash flow until end of year two, I'll still invite him and I'll say, listen, if this fits your criteria at the end of the Zoom call, reach out to me. Then he'll come to the Zoom call. He sees there's no cash flow. If he doesn't reach out to me, I know that he still wants cash flow. But then he might change. He might be like, you know what, man? I just closed. I'm in 3 deals with cash flow. I can now change. You understand? So I don't try and force deals upon people. I try and get people, I find out their criteria and I get them into deals that fit their criteria. Okay.
Okay. Thank you.
Mm-hmm.
And I'd like to say that a part two of this is that I want to get an actual deal up on the screen and walk through every single tab and every single page and go through the underwriting together first. I was going to try to combine them both today, but it would be very long and comprehensive. So I wanted to, do this call, and then I want to do a second call and put the two recordings together and now actually put everything to use and go through a real life example. And I want to pull up CoStar and I want to show you how we can extrapolate data and use CoStar. And then I want to put it into real life practical terms on the actual underwriting model and then open it up to questions and answers as well. So it worked really well when I just did it with a couple of MIH members. We went through a two-part course instead of rushing it. I know like Chris does a great job of doing videos, and everyone goes to see the 7-minute video, then the 30-minute video, then the 45-minute video, and kind of connects it all together. So I want to do
So
something like
Rob,
that.
Rob, that the next call is going to be amazing. We'll pull up a deal like you said, and you just go through the purchase price, strike price, the loan, the returns, the return tabs. Go through all the tabs of CoStar, and we'll go over a deal. And then we'll have both recordings. We'll
Yeah,
add them. We're going to add this recording to the library now, and I'm going to send it to all the. I'm going to send it to every single member to tell them to watch it and say, get ready for call number 2, which we're going to underwrite. We're going to go over a deal like a 10 unit or 20 unit or something. Okay.
exactly. Because if you now take some of this knowledge and apply it to anything that you're currently underwriting, I'm sure it will help. And then what we can do is we'll look at a real life example ourselves and go through every single tab using Chris's synthesis model. And then that'll be a good interaction amongst the team. And we can also extrapolate data from CoStar, from the OMs, and put it all together. And it'll be really a very good, comprehensive, detailed, and granular way where everyone could feel confident on the next deal that they underwrite. Even though it all takes repetition, it all takes practice, it's going to take time. None of us are experts, even if we've been doing it a long time. Like I'm learning something every single week. Some people who don't underwrite deals at all might give me a piece of advice that helps me out on the next deal. I'm very humble like that. I don't feel like I know it all. As a matter of fact, I'm the opposite. I feel like I'm always learning something every week and every day. And again, it's micro, it's macroeconomic.
Rob, I think you should pick a date in September before the event, like 2 weeks before the event or a week before the event on like now, like on a Wednesday, Thursday or something at 12. And I think we should shoot it before the event.
Yeah, that sounds great. That sounds great. So, but yeah, hopefully there was some nuggets that everyone picked up, some good knowledge, and then we'll apply it in real terms to another underwriting call. And you guys can feel free to call me, text me anytime whatsoever, just for any questions or help. There's a lot of good underwriters on our team. Everyone's got their different style, their different insights, the different way to do it. Some people are more analytical and operational. Some people like me are very sales oriented, but do like to look at financials, and everyone in between. So there's never going to be one blueprint or snowflake. Everyone's different in their own right. But I worry about the very very easily avoidable mistakes that that are made in some of these underwriting models, and I want to make sure everyone's protected and does things properly so that you're making great decisions when you get into your next deal. So, so thanks everyone. I appreciate it, and I am looking forward to part two.
Thanks, Rob. Appreciate you, sir. Have a great day, fellas.
You
Thank
too,
Take care,
you.
everyone.
guys.
Take care.
Bye,
Bye bye.
everybody.